The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then.
The 2008 recession's shadow lingers. Low-wage earners haven't fully recovered, student loan debt burdens young people, and a cautious housing market makes it harder to buy a home. This financial crisis instilled a fear of risk, impacting spending and investment, all while stricter regulations can slow economic growth.
I think our point of view is that this is going to be a severe inventory recession.
Now, what is severe inventory recession? A severe inventory recession is a nasty economic downturn triggered by a glut of unsold goods. Imagine stores packed with TVs nobody wants. That's excess inventory. When people stop buying, businesses get stuck with this extra stock.
We believe we're in a recession. 2 consecutive quarters of real GDP declines is the beginning of that definition. 3 consecutive months of declines in leading indicators, which we have now, would suggest the same. Now, I think the differences are, we see an inverted yield curve, and that, of course, is also a warning sign.
To avoid overflowing warehouses, factories slow down production, leading to layoffs and a vicious cycle. With fewer jobs and tighter budgets, consumer spending weakens further.
I think our point of view is that this is going to be a severe inventory recession, but we didn't have the systemic excesses like we did pre-08-09 in the mortgage market. So it's an inventory recession here.
Prices might even start dropping, deflation, as businesses compete to sell their excess, discouraging investment and spending even more. It's a tough situation to escape, emphasizing the need for businesses to keep a close eye.
7% in 2020 and has been slowing ever since. It hit 4.1% in August. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation, unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely.
This low spending on an individual scale may seem like a good thing. However, on the point of view of the industry, this causes stagnation and economic decline.
Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. And so Chairman Volcker did choke off money supply and inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked, as it did in 1981, until 1986 when oil prices crashed. So the inflation expectations and the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed.
Things can really turn 40 worse given the unique nature of today's recession. The current recession could take a nasty turn for the middle class. Aggressive interest rate hikes aimed at curbing inflation might backfire. triggering a sharper economic decline with more business closures and layoffs. Even if a full-blown collapse is avoided, stagnant wages could mean a shrinking paycheck struggling to keep up with rising prices.
Today, we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase, not a two-fold increase. Many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low.
This strains budgets, limits savings, and piles on the pressure of existing debt with higher interest rates. To make matters worse, government support systems might shrink due to a struggling economy, leaving the middle class with less of a safety net during this tough time.
The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then, and it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet, Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. So that was over a 15-year period that inflation had built.
A deepening recession would be a double blow. Job losses or stagnant income coupled with higher costs and shrinking savings, potentially widening the wealth gap and squeezing the middle class even further.
By the time the Fed got around to tackling it this time, it was not a 15-year problem. It was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic.
The global pandemic wasn't the only culprit behind the recession, but it sure messed with the recipe. Lockdowns tangled supply chains, making everything from TVs to furniture harder to get and more expensive. Labor shortages added fuel to the fire as businesses struggled to fill jobs, while stimulus checks boosted demand for goods at a time when factories were struggling to keep up. This mismatch pushed prices higher. Businesses, worried about the future, held back on investing, further slowing down the economy.
And we did not have the supply chain problems, 2 years worth of them, that we had because of the panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations, and yet Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd. After a very long period of very low interest rates, I heard someone say the other day, and we were talking about this LDI crisis in the UK, that the reason it's so serious is pension fund sponsors were beginning to think, and banks were beginning to think, that interest rates would stay very low for a very long time, for as far as the eye could see.
Lower interest rates hurts the business and investors. However, this is essential for the frozen market to move and grow.
And that assumption was built into the kind of derivative activity they were doing. No one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those margin calls were the banks, the counterparties in this case for these derivatives. And so the Bank of England had to step in and basically say pretty much the same thing that Draghi said, the chairman of the European Central Bank in 2011. He basically said, we're going to pull out all stops no matter what.
Now, businesses are taking risky steps just to recover. With no growth left on site, they are willing to do whatever it takes to earn profit.
While the BOE had been almost forced because of currency depreciation into following our Fed with higher interest rates, this was going to cause a great deal of harm to its system, and so it had to reverse its policy. So this is another reversal in policy, or it's a bit of a shift in policy. It's an outright easing, and they said they will continue until October 15th. So now all of these pension funds, in collaboration with the banks, are deleveraging, and they have till October 14th. So what do you do if you're deleveraging in an illiquid environment? All markets are experiencing duress today.
Woods mentioned the concept of quantitative easing. What is it exactly? Imagine the Federal Reserve as a giant water tank refilling the economy. During a recession, they use quantitative easing, QE, to create more money water for banks.
I think the Fed is a big part of that. So what do? You sell the most liquid assets. What are those? Those are government bonds. And so we're seeing U.S. government bonds, which are held in pension funds abroad, being sold, even though deflationary pressures are mounting all over the place. And so we think this is a bit of a financial crisis. And we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. Certainly this week was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until we get to 2% inflation. We know that we're getting a lot of deflationary signals, but the Fed isn't really buying into that yet. We think that the bond market, though, will start to convince the Fed.
Hopefully, new monetary policy and innovation can help address the inflation. While this may not be as catastrophic as 2008 financial crisis, several Americans never fully recovered from it.
So the bond market is telegraphing either much lower than inflation, lower than expected inflation, or recession, or both. And we've seen the 10-year Treasury bond yield drop from 4.25 to 3. It got down to 3.45. It's around 3.6 right now. So that doesn't leave very much room. If you assume that the long bond is kind of a proxy for how fast nominal GDP will grow, it doesn't leave enough room for much growth and inflation. And we also know that the market always leads the Fed.
It is always the mass, the people who control the economy. The Fed can only set monetary policies, but it is the people who will dictate its success.
And I think the bond market is speaking very loudly. Jeff Gundlach, very interestingly, Double Line's famous bond investor, very, very successful. He has made the point, okay, it does look like inflation's coming down. Why is it going to stop at 2%? And we would agree with that. We're seeing a lot of deflation in the pipeline. Commodity prices, discounts at retail during the holiday season to clean the shelves of massive inventories. So we think that's going to show through in terms of inflation. And very importantly, housing has taken it on the chin this year. Usually the Fed is very sensitive to that. Autos as well. They really went nowhere, and now used car pricing is down 14% on a year-over-year basis. So inflation will come down, and innovation actually is going to be part of that equation. The truly disruptive innovation platforms around which we have centered our research, so gene sequencing, robotics, energy storage, artificial intelligence, and especially artificial intelligence, as well as blockchain technology. All of them are deflationary in nature. Good deflation, it should cause a boom in the products and services associated with innovation.
Woods held high hopes for the emerging technologies and industry trends to help alleviate the recession. Tech can be a recession warrior. Fintech can get credit flowing to businesses, while blockchain keeps things secure. AI can streamline supply chains, and 3D printing might even make us less reliant on them. Sharing and gig economies offer new ways to work and save, while educational apps can make people savvier with their money. Tech can't erase recessions, but it can equip us with better tools to weather the storm.
But deflation, another source of deflation. So our confidence there is building. We've been right on the inventory build, the commodity price decline, and I think normally the market would have responded already. The market is waiting for the Fed. And so very similar dynamics. And what happened? Inflation peaked in June of 1920 at 24%. And within 1 year, it was minus 15%. We think we're going to experience a mini version of that during the next year. And then what happened? We launched into the roaring 20s when the stock market had, I believe it was a compound annual rate of returns of 25% for the next 8 years. The roaring 20s, we think we have a setup here for the roaring 20s.
Although the market is not especially good in these seasons, they are expecting the current decade to still showcase a good amount of economic boost.